The numbers filled out. The last thing we looked at the last day was we looked at our depreciations. Now we need to go and look at revaluing the buildings. So when we did this before, revaluation, we cancel all the depreciation up to the date of revaluation, and then we increase the fixed assets. So our buildings, it says factory buildings is 754, and our accumulated depreciation in buildings is 38,600. Okay, and I would have already depreciated, so that number isn't included here, so I'll do this now. So it says factory buildings 2% of cost, so that means my depreciation is 38,600 plus 754 times 0.02. Okay, now, and I just double check that I put into, so buildings, these are factory buildings, so depreciation of the factory will be in here. Equals 754 times 0.02. So that's the depreciation. So when I revalue, so down the bottom, I'm going to put in a revaluation reserve. So the revaluation reserve is going to be the new figure for the land and building minus whatever the old figure was, 754, plus we'll add on all of the revaluation reserve. So all of the figures that are included in the profit and loss balance. So that figure there. So that's 53,680. Okay, so that's my revaluation reserve. And now it means land and buildings now can go up to the new figure. So we'll have 0 depreciation because we've cancelled that. We'll put that into revaluation reserve. And the new figure for land and buildings is 880. Ethan, is that right? You remember doing that before? Next one, patents are amortized. So this is depreciating a patent. Okay, they've been written off over 5 years, beginning 2005. Now, patents are associated with goods I make, so writing them off is actually going to be included in the cost of a manufacturer. So I'm going to put those in here. So patent, write off. No. So that's going to be included as another indirect cost that's associated with the factory itself, and it's been written off over 5 years, beginning in 2005. So have a quick read and look at the top of the question. So we're doing this for 2007, so that means that we would have already amortized 2005 and 2006. So it's 2 years have already gone. So the figure that we have here for patents is 3 years left. So we've already, so patents cost 40 grand and they're now worth 24. So that means we would have taken away 3 years of it so far. Is that correct? Yes, so 12 grand every year. So 8 grand every year. So we've taken away 16 grand. So that's 2 years has been taken away so far. So we're going to take away another 8 grand this year. And in our fixed assets, we're going to have patents. So patents were 40 grand originally. We've taken away 24 plus another 8 grand, so we've taken away 32 grand. Is that right? Sorry, yeah, taken away 16 grand, no, so it's 24. 16 grand plus another 8 this year, so 24 grand, so the patents are now worth 16. Is it okay with that? Josh? Okay, so the figure for patents is 40 grand. Their net book value is 24. So we're now taking, so that means 8 grand a year has been taken off for 2 years. So we would have taken away 16 grand. We would have had 16 grand before, and we're adding another 8 grand in from this year. So that's why the net book value is now 16. So that's that write-off. Moving on to the next one. Directors recommend provision be made for. Now, if we provide for something, it means we're going to put it in as an expense, and because the expense hasn't yet been paid, we're going to have that as a current liability. So it's a bill that hasn't yet been paid, so we'll put those bills in. So debenture interest due and corporation tax. So debenture interest due is listed as current liabilities, and we have corporation tax due. So corporation tax due is 16 grand, so that's a new current liability, and we put that down the very bottom of the overall question, underneath our net profit. So we'll have net profit, dividends. Now we're just going to squeeze in here our taxation. So we'll have less tax, and then so the tax is going to be minus 16 grand. Now our debenture interest due will usually involve a little bit more calculation. So 12% debentures issued on the 31st of 15th. So I'm going to do this down here. So debenture. So the debenture interest now, 12% debentures issued on the 31st of the 5th, 2007, 100 grand. So the debenture interest is going to be 100 grand multiplied by 12%, so that's 0.12, and then multiply it by how many months of the year. So we got it on the 31st of the 5th. So that means we would have had it for all of the 6th, 7th, 8th, 9th, 10th, 11th, 12th. So 7 months times 7 twelfths. So 7 grand. I'll just increase the size of that. Okay. Then we have now, I'm just looking here and see, did I pay any debentures so far? Any debenture interest so far? Commission, profit, I'm looking for debenture interest paid. So there's no debenture interest paid. So that means all of the figure, so dividend paid is there, yeah, there's no debenture interest paid, so that means that's 7 grand, none of it has been paid so far, so all of it must be current liability. So debenture interest is going to go in here as one of the expenses. If we had paid 3 grand already, then 4 grand, we'd have a total of 7 grand here in the expenses, and 4 grand would be left over as due. But in this case, we paid nothing, so we'll go to our current liabilities and we put all 7 grand in here. Where's it? In there, and I'm going to put the debenture figure in here. That's that one. And finished goods to be transferred at current market value of 820. Now, what does that mean? So up here, if I can just go through this document so far. So the manufacturer account, again, this is the bit that's new. So just as a reminder, the first part of it is what they call prime costs. So that's all of our direct costs. Prime cost, direct cost, same thing. And the two main costs there will be labor, the workers who made stuff, okay, their wages, as well as materials. So we've got materials first, and then we've got other costs, which would include manufacturing wages. Then we're going to add any other indirect costs. So these are costs associated with keeping the factory running. So electricity for the factory, depreciation for the factory, supervisors for the factory, cleaning for the factory, any of those will be included in here. We'll take into account opening and closing work in progress. So work in progress for this year that we haven't finished isn't going to be included as a cost for this year. It's going to be taken out and transferred and becomes a cost for next year. So that's what I'm doing with the work in progress. Scrap material, so anything that I sold that was worthless, I take that away. That's not a cost. I'm not going to include that as a cost for this year. And I'll end up with a final number called the cost of production. This is the amount of money that I spent making goods. Now, when I go to do my trading profit and loss, that amount of money that I spent making goods is the figure that I will put in here, my trading profit and loss, instead of purchases. But in this question, it doesn't happen in every question, But in this question, they've told you the finished goods transferred at a market value of 820. So that means the market value of the goods we've produced are 820. Now, that 820 is then going to go in here. If it turns out that our cost of production is less than 820, and usually it will be less than this, then it means we made a profit when we produced the goods. As in, we made the goods for cheaper than we could have bought them for. Okay? And usually it will be a plus number. So whatever figure we get at the end for cost of production, take it away from the 820 we're given, and what's left is our manufacturing profit. And that manufacturing profit, when I've worked out my gross profit and my trading profit and loss, that manufacturing profit is added on to get my overall gross profit. Now, why are we doing that? Because we're taking it out and then adding it back in. Well, it's just we want to find out how efficient our factory is. Are we able to produce stuff cheaper than we could have bought it online ourselves? Is that everyone okay with that? Okay, so that's that last part of it. So what I'm going to do now is